When a customer sends money through a Fintech app, the screen may make the transfer look direct. Behind it, regulated institutions still have to clear instructions and settle actual balances. Many Fintech companies depend on partner banks for that access. In May, the Federal Reserve proposed a limited-purpose payment account that certain legally eligible institutions could request for clearing and settlement. It is a narrow infrastructure proposal, not a general account for every technology company. Clearing is the process of determining who owes what after payment instructions are exchanged. Settlement is the final movement of balances that completes those obligations. A card purchase, payroll file, or instant transfer can appear finished to the user before every institution has completed settlement. Direct access can reduce an intermediary relationship, but it also places operational responsibility closer to the institution sending the payment. The proposed account would not pay interest, it would not provide access to the discount window, and it would not allow intraday credit. Automated controls would prevent overdrafts. Closing balances would be limited according to expected payment activity. In other words, an eligible institution could use the account to complete payments, but could not treat the Federal Reserve like a source of emergency funding or a place to build a broad banking business. The proposal does not rewrite who is legally eligible for Federal Reserve accounts. An ordinary software startup could not simply apply because it processes payments. Eligible institutions would still face review by a reserve bank, and the proposal emphasizes controls for illicit finance risk. This distinction matters because headlines about fintech access to the Fed can sound much broader than the actual policy under consideration. A company that relies on a sponsor bank inherits part of that bank's pricing, operating schedule, risk appetite, and technical integration. The relationship can be valuable because the bank provides compliance and balance sheet support. It can also become a concentration risk if one partner controls the product's path to payment rails. A direct payment account could give an eligible institution more control over settlement, while leaving many other banking functions with partners. Removing an intermediary does not remove the work. The account holder must fund balances, monitor payment flows, prevent overdrafts, maintain resilience, manage fraud controls, and reconcile activity accurately. An outage or forecasting error becomes closer to the institution itself. Faster and cheaper access can be useful, but only when treasury operations and risk management are mature enough to carry it. If adopted, the payment account could create a clearer path for a limited set of institutions whose business is moving money rather than taking traditional deposits. It may increase competition in payment infrastructure without giving every applicant the privileges of a full-service bank. The important questions during the comment process are which institutions qualify, how balance limits work, and whether the controls protect the payment system without making the account impractical to use.